I just rolled them both together. Hold on. Don't read, Mark. Just remember what you know. You know the material. Most people who are introduced to investing are taught the basics: buying stock, trading options, and many other things. But have you ever wondered exactly what makes the market move? For example, how is it that a stock is up 1% and then in the blink of an eye, down 1%? Like, what the is the playing field really level? We're going to do a deep dive into that today. I'm Mark Monroe, and this is your Come Up. So institutional investors, they're the big guys on the block, aka the professional league. In my eyes, they're like the NBA. And if they're the NBA, we are the retail investors, aka mom and pop, individuals, the guys who think that they can play at NBA level, but you find them at your local 24 or LA Fitness on Saturdays. But these guys, they're much larger than life. They're the pension funds, the mutual funds, the money managers, the insurance companies, the investment banks, the commercial trusts, the hedge funds, and also some private equity investors. They're all over the place. He's such Institutional investors account for about 3/4 of the volume of the market. So when we say by volume, that's the amount of buying and selling for stocks that make up the market at any given time for the day. They move large blocks of shares and have such a tremendous influence on the stock market's movement. So remember when I mentioned at the beginning, I said, how is it possible for a stock to be up 1% at one point in time of the day, and then all of a sudden down 1% in the blink of an eye? Yeah, that's them. That's about 82.5% of the market, as well as they typically trade about 10,000 or more shares at any time. Wow. Just throw salt in the wound. But there's a catch. Most of the money that institutional investors use is actually not the money that they own themselves. Institutional investors generally invest for other people. So if you have a pension plan at work or a mutual fund or any kind of insurance, then you're typically actually benefiting from those same institutional investors, their expertise. So they are actually working for you. So when you think about it, you are slightly double dipping if you consider yourself a retail investor, but you also have a 401k plan. Imagine that. Let's talk about some of the perks. Because in the end, that's what it's all about, right? What do they get versus what we get? So let's discuss about what they get. So as an institutional investor, what they get first, well, since they do a lot of high frequency trades at large volumes, and then on top of that, they have way more capital, well, they get to have a little bit more negotiation power when it comes to those commission costs. And when we say by commission costs, every time when you look to buy or sell any type of trade or stock or whatever it is, you have to pay for that. Well, they get it at a smaller fee. The other thing that they get is they get to see things at a faster speed. So, which means that they get to see some of the action and possibly get in on that action, maybe either at a higher price to sell or say, for example, at a lower price, given that they get to see things in real time, and we typically get to see something in real time, but it's delayed. So what about us, right? What do we get? The little guys. Unfortunately, we get absolutely there's gotta be something there for us, right? There's gotta be something. We get nothing. We don't get to enjoy the perks of negotiation of commission costs. Oh, no, we do not. What we get higher commission costs. We pay for theirs. Why? Because we're the visitors of their home court. And for anybody that watches sports, home court advantage always matters. So, is all hope lost? Should I say forget it? No. Here is one major advantage that we get that they don't get. Time. Time is the greatest asset. Money can be spent and it can always be made back. Friends, you can lose them and then you can always gain more friends. But once time is spent, you don't have it anymore. It doesn't come back. And that's one of the advantages that we have as retail investors versus them. Because they work on the clock. They are always looking over their shoulder because they're trying to chase what is called performance. And what we mean by performance, institutional investors and people that work there, they're led based upon their earning potential and power. So they're always trying to increase their percentage returns and literally moving on to the next thing. They're not giving positions significant amounts of time. They are always chasing after the hottest stock at any point in time, which means that they can get out and then most likely they'll come back in later. But you, the retail investor, you're going to stay in more long term, which means that if they drop out, 9 times out of 10, they'll be back. Not only are you a retail investor, but you're also a consumer. And consumers, they get to dictate whether a product or service will ever be successful, right? I mean, think about it. Take McDonald's. If nobody went to McDonald's, I mean, where would McDonald's be? I mean, if there was nobody there for Facebook, where would Facebook be? It would be like a friendless social network. So in reality, institutional investors need us. Technically, we need each other because the big guys, they get to reap the benefits on all the early stuff, like, for example, the volume, the high frequency trading and low costs. But then we get to reap the benefits because over a period of time, technically you can outperform and really beat them in returns. So all is not lost. So when it comes down to the debate of retail investors versus institutional investors, my answer is we technically need each other. So if you're thinking about moving forward and making an investment or stepping into the market, don't be scared. Just only use this information to really help you see really what the landscape is. And now you know what you're up against, but also you know what advantages that you have. And in order to be a solid investor, study, do your research, study the fundamentals, what makes a good company, not just a good stock, but what makes a great company. And then once you find a solid investment, go for it. Hang on to it for a while. Because even that institutional investor, they may drop out now, they'll come back. If you like what you heard today, and if you want to definitely be a part of the Cool Kids Club, be sure to hit that subscribe button. And if you liked the video, or if you didn't like it, let us know. Hit the thumbs up or the thumbs down, but preferably the thumbs up. And if you want to be on the notification squad to find out when our next video is, go ahead and hit that bell. Feel free to share it with a friend, family member, or that one person whom wish that you know that's constantly losing in investments. Send it to them. Until next time, I'm Mark Monroe, and this was your Come Up. Peace.